Welcome back to Real Estate Mindset and good morning. Happy Wednesday. You guys, we're going to talk about what's going on in the economy today, what's going on with consumers, liquidity. We're going to go over the housing market and talk about why interest rates, mortgage interest rates right now are absolutely sinking. And obviously, guys, we'll take a look at consumer data and then we'll look at regional banks as well. The turmoil going on with regional banks is something that we definitely want to pay attention to. And I'm really excited to be back, you guys. I know it's been a while. I got displaced, obviously, the hurricane, just one life event after the other. So I'm really happy to be back. I'm really happy to be teaching you guys again and talking about the housing market, talking about the economy so that we can save as many people as possible from making a poor decision in purchasing a home. Plus, what I love to do is educate professionals in this industry because as professionals in the real estate industry, we need to step up. So another thing we're going to look at today, guys, is what's going on with the lawsuit, the whole buyer's rep. What do we have to do with the MLS? All of that stuff. And also, guys, the rates are sinking like a shark sunk its teeth into my finger. I got bit by a shark. Yeah, I got bit by a shark on Friday. I mean, it's just, dude, these life events are adding up. How do you prepare for that? How do you prepare for that? And then the hurricane, how do you prepare for those things? Guys, you just got to save as much money as possible and hope that the knocks and the hits stop. But I got bit by a shark. I had promised a buddy who was hosting a charity fishing tournament. So I fished a charity fishing tournament and filmed it. I promised him I'd do a documentary. He actually raised $10,000 for a cancer patient, and I got bit. Literally my finger. I'm not going to show you guys because you guys get creeped out. But anyways, a lot of stuff going on, right? What the hell, man? Why did I get bit by a shark, a hurricane? Why did I lose power? You guys, this is just life. And imagine if I would have bought a house, an overpriced house, spent all my money and have been trapped. I would be in credit card debt like crazy. I'm losing money, you guys. This is crazy. Anyways, it's just life. I just wanted to say good morning. This is my buddy right here. This is an OG Dooster first place comment champion in the house. Good morning, Dooster. You know I love you. And this is my man, Vovo. Vovo, dude, from the beginning, your support means everything to me. You guys remember this, okay? I'm just a normal guy, all right? I have a tremendous amount of experience in history and real estate, but ultimately, listen, and I'm talking to you, okay? You viewer, I'm talking to you right now. I'm just like you. I'm not God. I'm not perfect. I'm doing the best I can to be cautious and transparent. And then here's the thing, stay ahead of the turmoil. We got to stay ahead of the turmoil if we're going to become winners. Step one, being aware, guys. Step one, being aware, planning accordingly. But either way, again, I really love you guys. There's my buddy Mav. This is my buddy Raymond. Raymond, I want you back on the channel. I'm trying to do a members live where the members of Real Estate Mindset do the whole live presentation. The reason I want to do that is I want to show basically the YouTube community or even the world that community is important. In the Real Estate Mindset, we may not have the biggest community, but I'll tell you guys, a few people that I have met within our community, I look at you guys like family. I don't have time. Obviously my time is limited, but I look at you guys like family. I look at Raymond like family. Raymond's my buddy. I know what's going on with Raymond. Raymond, I want you to come on the channel. I want you to share your experiences on what's going on. This man, who you're looking at right now, this man right here, sweat equity. He's a hard worker. He's still single. So I'm not, I have children and stuff, so it's harder for me. But this man right here, I love you, Raymond, brother. The tenacity, your old fashioned beliefs. I just wish more people were like you, bro. Keep your chin up. I love you. Good morning as well. R. Talis. There's my man, Mav P. Darlene. Good morning to everyone. There's Kim. There's Vova. There's Dooster again. There's Trav. What up, Trav? What's up, Zimmerman? What up, dude? Whatever happened to TJ? Is it TJ? Did they get a house? What's going on with that person? I see your petty comments. I love them, Charlton. And here's the thing, you guys. I can't censor, I'm not going to censor anymore. Even if Comic Lover makes another troll account and harasses me, I don't even care anymore. You guys, I'm so freaked out on all the censorship that's going on. It's not going to happen here. So if you're a troll and you want to say petty comments, I just wanted to say, thank you for being a part of our community. We all have members of our family that we don't like. It is what it is. You're still part of the family. You're going to have a place at Thanksgiving table. is what I really wanted to say. But I mean, my God, you guys, the censorship, is that not freaking crazy and scary? Coors, good morning, good morning, good morning. There's my buddy responding. There's Nate. There's Mike. You guys doing all right out there? Seriously, I'm talking to you. Tell me, how are you guys doing out there? You guys starting to feel it? You guys getting sick and tired of these headlines? Resilient consumer, resilient economy. I mean, I'm sick of it. Look under the headlines, scratch beneath the surface, deficit spending, government jobs. I mean, this is not hard to see, but why isn't it in the headlines? Why do we have to dig deep as consumers? And I'm going to tell you guys, because we cannot trust the media. We can't trust them. We cannot even trust the data. Can we trust ourselves? Some people can. Some people can't. The people that should be in a position to trust themselves are learning right now. They're staying disciplined right now. They're cutting back on how they're living, right? One of the biggest problems that I'm seeing in society right now is not just the inflation. The inflation's horrible. The Fed is horrible. All the stuff they did to us is horrible. But let's not forget, you guys, there's a two-part to that equation. Okay, yeah, it's the Fed. We're all hurting from that. Middle class is evaporating. We're struggling. We're hurting. We can't save, or it's a lot harder. But on top of that, guys, it's our toxic spending habits and our mindsets that get us in trouble. And here's the thing. The older you are, less likelihood. But why? Why? Why is that? Why is it the older you are, the less likelihood you're in debt? Why is it? What do you guys think? Any comments below? What do you guys think? Experience. I'm not trying to be a drill sergeant. I'm not trying to just preach at you guys. I have experience. That's it. I mean, I lost everything and I've been an agent in this field. And the best thing of all, you guys, and this is a result of God, as a result of losing everything, I now know how to walk away from money. That is so important. There's so many content creators and professionals that they want to act genuine. They want to act like they're going to help you, but their entire goal is financial. Now, finances are important, right? Making money is important. I'm not knocking them for that, but I am saying the more motivated you are by money, the less truthful you can be. The less honest you can be, the less forthcoming, the less transparent you can be, because you always have that motivation to make money. So again, you guys, that's why for the last 2 years and about 4 months, I haven't sold. What have I sold? I haven't sold anything. And it is hurting me a little bit because I'm used to sales. You make more money. But the thing is, guys, again, what I'm really saying here is that's going to lead me into the school. I have made 8 different courses so far. I think you guys are going to love them. Anyways, let's go into the mortgage update right now. I want to show you guys, we're going to take another dip into the mortgage update. And I want to remind you guys, okay, so remember, a lot of people are like, oh, when's the Fed going to cut rates? But remember this, guys, okay? Let's see. Let me gear this up like this, okay? All right, let me move this out of the way. So I want you guys to remember that even when the Federal Reserve cuts interest rates, that's not what's driving mortgage rates necessarily. The federal funds rate is at best manipulating mortgage rates, but I wanted to show you guys a case in point. Here's the federal funds rate. This is a list of the federal funds rate. You guys can see that the federal funds rate has remained unchanged since August of 2023, okay? So almost a year, right? Almost a year. Not quite a year. It's 10 months, so not quite a year. But look at this. This has been flat for over 10 months. See that? So the federal funds rate has stayed roughly 5.33%. But look at you guys, even though the federal funds rate has not changed at all, look at the trajectory of the interest rates. But the interest rates have been all over the place, okay? And again, if we look, what have they gone up to? From 8% to 6.8%. So that is a roughly 120 basis point swing. And yet the federal funds rate, again, over here, has done nothing, okay? See, massive movements in interest rates for residential mortgages and mortgages in general, but yet no movement here. That's because there are things happening in the background that are manipulating mortgage rates, and you really got to look at the long end of the yield, okay, or the 10-year treasury, okay, and that's this right here. So that's why we constantly watch the 10-year treasury. And I'm going to tell you guys, if you guys understand the 10-year treasury and how it works with residential mortgage rates, you guys are ahead of 80% of the professionals in real estate. As a consumer, listen, you guys should be proud of yourself. That's why I'm saying this. So proud of yourself, guys. No one knows about this, what I'm telling you in my business. Like it's so barely anyone knows this. So the fact that you know that this 10-year right here is tied to residential mortgage rates, it puts you above a lot of people. Okay. And then again, we'll go into pricing and we'll go into all that type of stuff. But here's the thing, you guys, the 10-year treasury has been plummeting. And what is that right now? So it's down 2 basis points, but that has been going down. And just to put this in perspective, let me put the 1-year chart so you guys can see it. We are down, but it's not like the end of the world. It is trending downward, but we're matching March of this year. So we're still elevated. I mean, everyone wants this sucker to be high because we want the housing market and the economy to come back to balance, which means deflation or prices going down. So we want that bad boy going crazy, right? But what I'm saying is it's still elevated. It is plummeting because remember, we got close to 5% at one point. I think that was in October of last year. But this is going down. We're still over 4%. You guys remember for about a year, I was campaigning for like, we need 4% or higher. So we're still at 4% or higher. We got about, 18 basis points left, staying on the 4%. So a lot of, we're okay. We're okay. Okay. Don't get freaked out. Remember, the market's ran by trust and confidence. The market's ran by emotion. Is that crazy? That's crazy to me. But anyways, let's keep moving on, you guys. So let's go here now to the mortgage rates. Okay. So you guys are starting to, putting the picture together, right? Federal funds rate, 10-year treasury, mortgage rates. Here we go. Now, remember, a couple things I want to remind you guys, okay? Here's what I called this when I was a loan officer back during the great financial crisis. I worked for a broker shop, and I'd have someone call me like, hey, Travis, I want to refinance. What rate can you give me? Okay. So what I would have to do as a loan officer working for a broker is I would call what's called an AE or an account executive. And so back in the day, and even today as a broker, we would have 30, 40 banks, regional banks come to us and try to solicit our business. And they would say, Travis, we have the lowest interest rate. All right. And so as a loan officer, you want to get your client the lowest interest rate and the cheapest closing costs, right? As a loan officer. So when I would get a customer wanting to refinance and I would request their documents, their income documents, their qualifying documents, and I would put the loan application together. At that point, what I would have to do then is I would do something called price the loan. And I want you guys to remember that. I want you guys to remember those words, price the loan. Because as a consumer and even a professional in this industry, that's what really matters. It's the price of the interest rate that is changing every single day. So remember that, guys. It is the pricing. And another thing I want you guys to remember is shop your mortgage. No one wants to shop their mortgage because it's not fun. Shopping for a mortgage is not fun because you got to send in all your documents and people don't want to send in all their documents, their paycheck stubs. But you guys, I'm going to say this, don't get lazy. Don't get lazy. The more documents that you send in advance, the better job your loan officer can do for you. So if you're fighting a loan officer, I don't want to send in documents. Understand, if you don't want to send in documents to get qualified, you're working against yourself and you're being lazy. Just saying. Some people, not all, they fall into that trap. Okay, so you want to be proactive. All right. But anyways, you guys remember that's called pricing. Shop your loan. Generally, you're going to get a better deal with a broker versus a direct lender because remember, a broker generally has lower fees associated with staying in business. Okay, direct lenders have generally a lot higher operating expenses. And then also, as you guys can see here, generally FHA mortgages are cheaper as far as your interest rate. Okay, as far as your interest rate, look at it. So today we're sitting at 6.28% FHA, 30-year fixed. That is the lowest interest rate of all of these different categories of loans. So you have your conventional here, significantly higher. Even the 15 years higher today. VA is higher today. So again, FHA generally has the lowest interest rate. All right. Now, remember again, pricing changes daily. So here's the thing, y'all. A lot of people are anticipating refinancing. So let's go into the amortization schedule real quick. And I want to show you guys the true cost of refinancing because we get suckered a lot. And people are like, oh, just refinance when the rates go down. And that's fine, right? Refinance when the rates go down, but understand what you do. Understand what you did because the bank doesn't want you to understand, guys. Why doesn't the bank want you to understand? Because they get filthy freaking rich. They get filthy rich off of these amortization schedules. You guys got to get yourself out of this amortization schedule when you decide to buy. Okay, so whether it's 2-3 years from now, 2-3 months from now, whenever it is, or if you already own a home, y'all got to get out of this trap. This is 100% trap. This is the second worst debt, in my opinion, outside of credit card debt. The reason is it's front loaded with interest. Okay, so I want to put this in perspective. I want to tell you guys how much money you waste owning a home right now in just 3 years. So we're just going to look at the 3-year mark. Okay, so looking at this amortization schedule, you can see that this column, okay, has interest. How much interest you pay in the year? This has principal. So in the first 3 years, you guys, okay, so first 3 years of your mortgage, you guys pay back. And this is, let me show you how I'm doing this. This is a $324,000 loan at today's interest rate of 6.84%, which gives us a minimum payment of $2,100. That's just principal and interest. That's not including taxes and insurance, okay? So $2,100, not including taxes and insurance. Now, here's the thing, guys. In the first 3 years of that loan, you guys pay $65,432 in interest. These first 3 rows right here. Okay, that the first 3 yellow. Boom, boom, boom. So the first 3 years, you pay back $65,000 in interest, and you only pay down $10,000. Almost $10,900 on your principal. Okay, but here's the thing. When you refinance, it's probably going to cost you $10,000 to refinance, and you have to start this whole thing all over again. If you guys refinance from a 30-year loan into another 30-year loan, all of this in yellow here, you guys see that, is essentially paid for nothing. You've just paid the bank this profit. Okay, and I'm explaining this to you because it's not so clear cut right now, renting versus owning. It's just never been a better time to rent versus own right now. Even though renting, I understand how expensive it is, there's just a massive gap. It just doesn't make sense to most 99% of the time. 99% of the time. So don't hold your breath for the 1%. It does not make sense to buy a house at this point. We know that. We know interest rates are elevated. We know there's quantitative tightening. We know the unemployment rate's going up. We know the recession indicators are flashing like crazy. We know everyone says this time is different. Fight the Fed. It's fine. We know these things. The writing's on the wall for the people that want to read it. In fact, you guys, there's not even writing on the wall. It's a freaking book now. So we have a book on the wall. It's up to you whether or not to read it. Okay, but we've been in this situation before. Nevertheless, you guys, remember, if you guys are going to do a refinance, maybe try to do like a 25-year loan, a 20-year loan, 15-year loan. But if you go 30-30, you are putting yourself in a situation of risk, of being stuck on that mortgage. Now, remember, if you can, okay, if you've rebudgeted, I don't want you guys to go broke, but if you can, make extra payments. If you guys if you can, give me an extra payment to put here. So I want to show you guys what an extra monthly payment would do as far as how much time and interest it would actually save you. No, I did not. You know what? Zimmerman, I want to show you my finger, but it's nasty, dude. I got bit by a shark on my finger. It's messed up. And he is right. It was, wait a minute. No, I didn't get in a fight. But man, I lifted. Okay. So here's one right here. All right, let me mark this question because I'm going to have a segment, you guys, that is just going to only talk to you guys about your questions, okay? So let's go right here. Kim said $300. So let's do what Kim wants to do. Let's put $300, and let's see how much money we can save with $300, all right? Let's calculate this right now. Okay, good. So if we put $300 extra towards principal a month, we save 8 freaking years and 10 months. We save 8 years and 10 months. We save we save $150,000. So if you can afford $300 a month extra, you save $150,000 in 21 years and 2 months. $150,000, guys. I mean, that's the power of these traps, these mortgage death contracts. Mortgage death contract. But get out of it. Don't be part of the rat race. Stay disciplined and do the best you can to get out of that sucker, because it is a trap, you guys, and I just wanted to make that clear, okay? So let's move on. Look, this is crazy. This is crazy right here. Thank you so much, Kim, for participating, but that's crazy, right? I mean, that's a lot of $150,000. So take a look at the market. The market's crazy. This is See Me Fed Watch. This is the market's anticipation. What's the Fed going to do next? Here's all the smart, greedy, overly optimistic people right here that never get things right. So you should know, we can't trust these people because they never get it right. Now, here's July. There's going to be more than likely no rate cut in July, but take a look at September. Massive movement in September. Huge. The market, what you guys are seeing here, this is the market. Zimmerman, I see you. I see you. It was a 3-foot bull shark. Zimmerman, it was a 3-foot bull shark. That's what got me, a 3-foot bull shark. It wasn't even a big shark. It's the little ones, man. I overreached like the government. Okay. And I tagged the tooth. Anyways, so September, look at that. 93% likelihood, according to the market, a rate cut in September. But look at this as well, you guys. So again, they're probably going to cut rates in September. But when I go to the end of the year, look at that. Massive changes. So they're basically saying no chance of no rate cut, no chance of one rate cut. And basically they're now betting on 3 rate cuts of 25 basis points, okay, which is a total of 75 basis points. You see that right here. That's what that 450 to 475 represents right here. That's 3 rate cuts. So that's the market, 51.7%, 3 rate cuts here, or 40% likelihood of 2 rate cuts by the end of the year. What you guys are looking at, though, is definitely not something that we can rely on as far as what they're going to do next, but it is intriguing to see how overly optimistic the market continues to get. And that's probably why when we go into recession and depression and all these types of things, it hurts so much. And that's probably why people get so blindsided. That's why you guys saw the word blindsided in the thumbnail. It's because I don't want you to be blindsided. And all you really got to do not to be blindsided, what do you guys think? Prepare for the worst. You can hope for the best. Fine. Do you guys like my shirt? My wife got me this. You guys like that? You guys like it or no? It doesn't matter. I hope you like it though. Anyways, guys, so let's go to our first video right now. And our first video is going to, oh my God, I forgot the timestamp. Our first video is going to be on Powell. Okay. And listen, you know what? This dude, right? I am, for me, you guys, I'm going to be honest, the jury is still out for me on Powell. I want to believe in him, but like, okay, so he's going to talk about how they basically underestimated inflation. Okay, he's going to explain, well, what happened with inflation? Why has it been so sticky? All right, so thank you guys. Thank you. Appreciate that. What is it? No, Rocket Mortgage, dude. Here's the thing, Coors Light. I'm not trying to talk trash on these companies. I don't want you to get confused on me bashing these companies, although I think they need a good bashing because that's what they've earned. The main thing here is that you, Coors, I'm talking to you now, that you are empowered enough to make it through this process, brother. There's a lot of pitfalls. And unfortunately, when it comes to real estate, you don't know what you don't know. And that's why I feel like I could be such a help to so many people because I've been a part of 1,000 transactions, right? For one thing, right? But I don't want to bash these people. I do want to bash them. But what's more important is that you guys understand why I'm saying what I'm saying. What premise, right? What's the concept? Why, you know what I mean? That's the main thing. What premise am I trying to teach you? I hope you guys are getting that. So we're going to listen to this first one. Let me know if you guys can, that the audio is okay.
When inflation began to arise after COVID, at some point people said, including you, that it was transitory.
Hold on.
In hindsight.
Hold on. So sorry. I'm going to play this. But do y'all see this comment? Fed always overdoes it in both directions. It's the only way. Well, they said screw the masses, but it's the only way to cause a recession, a reset, busting the bubble. I want you guys, if you can, I'm going to play this video, but can you let me know if you guys agree with Andy? I agree. And it's sad that people have to be blindsided, but people have to be blindsided, unfortunately. And it is what it is. But let me know. You guys agree with what Andy's saying here? Let me know.
What do you think people missed about the nature of the inflation? Why was it more enduring than people initially thought?
So this is a question that people will be writing papers about and debating long after all of us are gone. And it's early to say. It's actually kind of soon to be answering it. But I think so. Here's my answer to that question. When inflation arrived in March of 2023, it was really coming out of the goods sector, and it was connected to really high demand for goods, and it was. And the supply chains, global supply chains, which account for most manufactured goods, collapsed because of too much demand and because of COVID. And, you know, so, and to us, that looked like a temporary fleeting situation. We also lost several million people out of the labor force. So wages went way up as the economy really boomed when we reopened the economy. And we thought, you know, we were getting vaccines were coming in, and we thought that that would fix itself too. Kids would go back to school. We essentially overestimated how quickly the economy would return to normal. These things finally did happen in 2023. But they didn't happen in 2021 or 2. And what we meant by transitory was that it would go away fairly quickly without the need for our intervention. You don't want to intervene with interest rates if something's going to go away quickly without us intervening, because, you know, monetary policy, as I mentioned, works with long and variable lag. So the lure is you look through things like a temporary oil shock. So that was the mistake, was that it actually didn't reverse itself. The problems with the supply side didn't reverse themselves until 2023, when they really did, when we got a big burst of employment and also the supply chain.
All right, guys. So wages went way up. That guy is so detached from normal people. I mean, am I wrong, guys? I mean, how did wages go way up when all of the data, again, adjusted for inflation, shows that it actually went way down? And the economy is doing great. Well, it's not doing great without the propping up from the government deficit spending. And that's why so many people, you guys will see in the comment section, anytime I do a video on recession, I have so many people, Travis, you're crazy. They say you're not doing enough. I'm trying to be balanced, man. I'm trying. This is how I feel. But they're like, we've been in recession, and their main premise on like this is why they're saying that is because the deficit spending, and that's why you see so many people say we've already started recession. And some people say we've been in recession since 2012 or since the GFC. And again, it's because look at the government deficit spending. That's a real thing. There's no emotion there. That is a fact that we can follow. That is a data set that shows us how unhealthy the economy is. And I don't know about you guys, but I get so frustrated when I hear people talk about how resilient the economy is, because it's not. Because if it was resilient, we wouldn't be running at a deficit greater than the great financial crisis. I mean, just, you guys agree with that? Guys agree with that? Let's go into the real estate update now. I'm going to show you guys some MLS trickery. We're going to listen to the new MLS changes as well. Now, okay, what's up, RE Watchman? RE Watchman's in the house. Oh, I want to talk to you, man. I want to do a video with you, RE Watchman. I see your hard work out there. As far as like, here's what I like what he's getting right now. He's investigating, and it takes a lot of time to do this, investor homes being sold. That is a big deal because there's speculation, because we know how many investors own houses, mom and pop, institutional investors. So he's watching that, and he is seeing that accelerate. And that is very important to understand. Very important to understand, because why are they doing that? Why would they be selling their real estate? I mean, always ask yourself why, right? Ask yourself why. So it's nice to see you, brother. Hopefully we can do that here soon. Let me show you guys this next thing real quick. All right, how do I want to do this? I'm going to do it like this. Okay, we're going to go into the MLS. Let me show you some MLS trickery. Now, people that have been following me for the last 2 years have known that I've been keeping us in a very tiny housing market because it's hyper-local of Kingwood. I do that so we've had one market to track, and I can't manipulate the data because it's a small market, and I have peers that can check my work. So if you're in Houston, check my work. If you have access to MLS. So I'm going to go, and first I want to show you guys and tell you guys, first of all, how many listings are actually in Kingwood. Okay, so you can't see that on the bottom here, but let me show you the results real quick. So here's active listings in Kingwood. Highest it's been in like 3 or 4 years. So remember you guys, I was like at 88, right? We're like 90, 88. It has ballooned, skyrocketed up. Okay, this is our tiny housing market. It has skyrocketed up to 123. If I'm not mistaken, that I have to double check it in Kingwood. I didn't look before this, but that's near pre-pandemic. So it is exploding again, you guys. Let me go back and I want to show you this, okay? So what I want to explain now when I'm opening the MLS is when you add filters, or if you have your agent, and you guys don't don't take what I'm saying lightly. You gotta shop your realtors as well. And the way you test your realtors, one way is your data. Like, can you run data? Do you understand? Are you just a talker? Are you just a cheerleader? Or are you a data person? What type of realtor are you? Are you a data person or are you, a manipulator, right? That's what sales is. Anyways, so I want to filter this now, all right? I don't want to look at 123 listings. So I'm going to put Kingwood in here, and you guys should do something similar. And what I'm going to do is I'm going to take, so I have 123 listings. You can't see that, it's by where my name is. And what I want to do is if I want to see kind of who's in distress, I click on price decreases. All right. So when I click on price decreases, it gives me 44 homes. So I have 44 homes. Let me show you guys the results. So I have 44 homes out of the 123 in Kingwood that have price cuts. Now that represents a 35% of all listings with price cuts. But the thing is, guys, those other ones that are not listing price cuts, they could have just relisted their house. Remember that. So even if it doesn't say a price cut, they can relist the house. Now, the way you find out is you go to the MLS and you go to archive, property archive right here. Okay. And this will tell you when, see, look at this. See? So this will tell you how often that home has been on MLS. So you can kind of see what's going on with the seller. You don't want to just take it at face value. Okay. So that's one tip I'm trying to give you. But again, what I'm trying to show you guys is look at, so now just if by adding that filter of price decreases, I've taken 123 and I've turned it into 44. Let's look at the map. Okay. So here's what the map would look like. Still a lot, right? That's still a lot. Okay. That's still a lot of listings. I want less listings. Okay. I want less than that. So let me show you what I'm going to do. And this is, again, this is how we kind of pinpoint finding a good deal. And there's not many, if at all. Okay. But again, so that's the price decline. But there's something else I want to do that's even better. So I'm going to type in again, Kingwood. And if you're an agent, you have the ability to do this if you're using Matrix MLS. So I'm going Kingwood. Again, it shows me 123 listings, but watch this, guys. I added on the bottom of my MLS Matrix, price per square foot. You guys know it. Price per square foot is not the perfect way to find a great property, but it is the start. It is a great, simple way. It's a simple way to find this stuff. You guys, so all I'm going to do is I'm going to put price per square foot from $1. And you guys know my magic number, right? You guys know my magic number by now? What am I looking for in Kingwood? What if I told you I've been 100 and what? I want to see if anyone gets this right in the comment section. You guys, if you're listening, please stop listening. Start typing. What price per square foot have I been looking for in Kingwood? Does anyone know? Anyone know at all? Anyone at all? Is it early? Is it too early, guys? It's early. I know it's early, but come on, stop listening. Well, listen to me, but stop. Type in the comment section. Deuster, 175, Deuster. You hurt me, Deuster. You hurt me, brother. No, not 140. You guys have been talking about this when I'm talking about it. No, not 155. No. Charles, what's up? What's up, buddy? What's up, Brian? How you doing, brother? Always nice to see you, man. Always nice to see you. So close. Volvo's the closest. And oh, my man. Yes, 120. Yeah. So check it. I'm going to go 120 in here now. And let's see if we can find any listings with $120 a square foot. All right. So I'm going to go to the map. Take a look. Look at how much easier I've made this for myself. See this? Now, instead of me looking at 123 listings or even 44 listings with price cuts, I don't care about price cuts. I don't care about DOM. What I care about is the price. I care about the value, right? And that's the problem, you guys. There's so many people that don't understand how value works. But look at, now I have 7 houses. And take a look. Here's the first house right here. And look at this. Okay. So that's 2,600 square feet, 315. That's not bad. And let's look at this one. And look at this one, you guys. Here's what's crazy. Look at the owner. This is why I need more realtors and people doing boots on the ground stuff, because when we really investigate in a housing market, it's so localized, we can see what's going on. Like, what's going on, man? Like, we need to understand what's going on. Look at this first one right here. So we have an investor. This is Black Walnut Homes, LLC. So we have an investor now selling a property for under market value. Thank you, investor. We actually need that. It's in a balanced market, that's not good. But let's investigate, okay? Let's investigate this. Now, remember, you guys, property archive. That's the first thing I want to see, okay? So let's see when they, oh my gosh. Dang. Okay, so this is very telling. Okay, so okay. So this, dang, this is crazy. So this investor, this is crazy. This investor has been trying to sell this property, House Hacker. Good morning, House Hacker. Hopefully San Diego is good. House Hacker's a veteran. Thank you, brother. And you've only owned 2 houses. I didn't know that. So House Hacker, you've only owned 2 houses. Last house you purchased, absolute stud. Good job on that, brother. So look at this. So it's been listed since January of 2024, and it was originally listed at 399,000. Is that crazy? So it was listed at 399, and now it's been price dropped. What, over what, $65,000? That's crazy. Look at this, and they just keep dropping it. Boom, 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 boom. So an investor can't even sell this house for under market value. Is that wild, guys? Let's look at the condition. So this is being sold for $119 a square foot. There's your price drop indicators right there. Let's take a look at the condition here. I want to see the inside of this house. See what's looking like. Unbelievable. So under market value, investor owns this. This first picture is showing me, Raymond, get my back here. Where you at, Raymond? This is not bad so far, is it, Raymond? Look at the, where's the holes in the wall? I can now find property under market value in this condition. And this has been on the market for 100 days, over 100 days. Look at the condition. The housing market's resilient, the consumer's resilient. Then why has no one bought this house? Why has no one bought this house? Housing market, consumers resilient. This is a nice house. It's under market value. You would buy wedge. You buy this house, you're going to have wedge. You're going to have wedge as long as the housing market doesn't go down, say 30% roughly. I mean, you're going to have wedge today, maybe. But I mean, the kitchen's a little small, so you can add some cupboards there, right? Make the kitchen a little bit bigger, put in some sweat equity, maybe it's already got molding. I mean, there's not a lot you could do. It looks like they already painted the board right here. This used to be probably wood right there. So, I mean, that's actually, the kitchen's a little bit bigger than it looked. Dang. This isn't a bad, look at the kitchen, guys. Look at that. That's a nice, I mean, come on, man. That's not bad. That's not bad. That's actually impressive. What I would have done, though, you see the brick right there? I would have probably painted that brick gray. Probably gray, so it kind of flows. I like the older houses because of that type of stuff. I almost got one, but I decided to rent again for a year. Oh, look at they did the bathrooms, guys. Look at, they did the bathrooms. So again, you're dealing with a property that's been listed for over 100 days with $65,000 in price cuts, owned by an investor. It's pretty nice condition, good for a first-time home buyer, but no one's buying it. Why? It's overvalued still. It's still overvalued, even though, yeah, there's wedge, yeah, cool wedge, but it's still overvalued, and it's still really, really unaffordable. That is how out of whack the housing market is right now. Now, granted, I'm in Houston, but Houston's the only major metro area in Texas that doesn't have year-over-year price decline for all homes, right? Median price groups that they're using. Houston's the only one. So again, I'm showing you behind the scenes, even though it doesn't show Houston year-over-year decline, look, I can find houses with decline. Here's one right here, and this is a nice house. So anyhow, I think is that all I wanted to tell you right there? So that's about that, you guys. I mean, I love being able to go into the MLS to show you this. Let me go in to show you guys a little bit more. Okay, so take a look at this. This is crazy. Okay, so we're going to keep talking about real estate, all right? Okay, so this is what? This is from yesterday, July 16th. Okay, this is from Seeking Alpha. The housing market hit a wall in May and June. It's headed south pronto. The reason I want to bring this article up, y'all, is because this is going to tell us why home prices don't appear to be going down when the reality is it actually going down. And one thing that also frustrates me, I hear this all the time from my man Vital Signs. Vital, where you at, man? Man, I miss you, Vital. I treated you with nothing but love and respect. You had a completely different of an opinion, but we treated you like a brother. Where are you, bro? You abandoned us. I miss you, man. I miss you. I like Vital because I listen to people that don't share my opinion. I think it's really important to listen to people that don't agree with you and to understand what their premises are and their concepts are, and then kind of analyze that, right? We don't need exact data. It's just like, why do you think that? What's the premise? What do you see? Okay, Vital? Vital is struggling like a lot of other people. Anyways, guys, take a look at a few bullet points. The thing is, again, this is going to explain it's like the upper 10% of people still buying, and it's manipulating median sales price. Now, again, a few bullet points I'm going to show you guys. Let me put this back on the screen here. All right. Now, bullet point number 1, in taking a deeper dive into the existing home sale report in May, I noticed that the distribution of sales across the 6 price buckets show a different story than the headline number broken out by sales regions. And anytime they do price buckets, in my opinion, that's not true median. If you want true median, then just throw it all up and get the median. When you do the price buckets it's just another way to manipulate median. Bullet point number 2, recent reports indicate a surge in listings and price cuts in previously hot markets like Florida, potentially leading buyers in top price buckets being underwater. But I'm going to be honest, guys, it's saying just top price buckets, people underwater? No, it's most of the people that purchased within the last 2 years. Doesn't matter your price point, doesn't matter your area. What does matter is how you bought, though. If you bought wise, wedge, cash flow, you didn't overextend, no consumer debt, right? You're probably doing okay. But most people didn't do that. And the people that are buying at the top, the wealthy people that are still screwing us, those people are probably already underwater right now. And I'm not talking about a little bit underwater, like 10, 15, whatever. I'm talking like $150,000, $200,000. Just saying, guys. Now, bullet point number 3. The home builder stocks went up straight for the last 3 days on the week, triggered by better than expected CPI report. Isn't that great that the CPI is going down? Can you guys feel that? Can you guys feel the CPI going down? Because I don't. I feel things getting worse, not better. I mean, it's just impossible to figure out what's going on. But take a look at these charts. These charts are going to tell us and show us why median sales price appears to be going up. Because again, I get sick and tired. Oh, the house market's resilient. If you guys look at median sales price from peak to peak, like from right now to 2 years ago, home prices went up about $6,000 in 2 years. So the house market's so resilient, but it's only gone up $6,000 roughly in 2 years. Shut up. Just shut up, bulls. I'm just sick of you. I'm just sick of you because you're not explaining why. Why? Here's the price buckets. Take a look, you guys. Anything under, okay, so look at anything under $250,000, there's a lot less growth. Okay, you guys can see that this is changing the percentage year over year. The growth has been 1 million plus. Look at that. So 1 million plus houses, 22.6% growth year over year. That is a substantial growth for just year over year. When we're talking about $750,000 and up houses, that's 12.9%. Then 500 to 750, 6.9, and then 250 to 5 is 1. And then after that, you guys, it goes to negative 5.8 and negative 16.7. So a lot of that, again, is built on that higher end of the median. And that's not guessing. We're not guessing. The data's here. Anyways, let me read a couple of this for you. This is really, really good stuff. The table above is from the supplemental data link of the National Association of Realtors news release. The data is the not seasonally adjusted monthly data. On a monthly basis for May, the NAR data shows an estimated 364,000 homes, which is no change year over year, sold in May at a median price of 380,000. Half sold above that price and half sold below that price. The headline numbers, however, are, and pay attention to this part. This is not me saying this now. This is someone else. The headline numbers, however, are deceptive. And then remember what I asked, guys. Why? Remember, ask yourself, why? Don't just assume. Why? Okay. Per the table, the 2 highest price buckets show double-digit increases in the number of sold year over year, while the 2 lowest price buckets declined. All of the action in May sales was in the 2 highest price buckets, while everything below the top 2 buckets was flat to down. You guys get it? You guys getting this? The data reflects the degree to which buying a home or moving up from a starter home has become unaffordable for the majority of households. Duh, right? Duh. In fact, Friday's U of Michigan Consumer sentiment report discussed below showed that home buying conditions in June hit a record low for the history of the data set. It's changing, you guys. That's what I'm saying. Let's not get blindsided here. Now, this last thing here, given the most recent report based on Zillow data, many of the previously hottest housing markets are experiencing a huge influx of listings because the show is ending. The party is over. Inventory is exploding. I don't mean to talk belittling. I'm just like, my God, finally, right? That's just me. Like, finally. People have a short patience window. Okay, people can't be patient. Huge influx in listing and big price cuts in listings. In most areas, the buyers in the top 2 price buckets will soon be underwater on their home purchases. Moreover, as the amount of listings pile up in various MSAs becomes more visual to prospective buyers in the top 2 price buckets, many will hold off buying. Let me show you guys this. Here's inventory. Okay, we have inventory updated as of July 9th. We now have 839,000 active units. All right. Right before lockdowns, okay, if you look at January, and January is generally the low year, so I mean the lowest month, we had 951. So that means we are so close. We are so first of all, some metro areas are above pre-pandemic, which is, thank God. And honestly, you guys, we would have been there last year, but the bubble last year, I mean, the bubble got worse last year. We had the bank term funding program. Everything was fine. No recession. This should have happened last year. We wasted 2023 because no one let us. I mean, they just wanted consumers to keep spending. No one let us. Everyone's like, just spend. Everything's fine. But anyways, we're very close. And the trajectory is going up. This is a very beautiful thing. This is an indicator. This is one of the leading indicators. Active listings is a leading indicator. Here's another leading indicator. Days on market. Days on market's at 30. This is the median days on market according to Redfin for existing homes. 32 days. Substantial increase. All right. And just put in perspective, okay, in 2023, it was 27 days, but in 2021, it was 21 days. And in 2022, 20 days. So my point is this sucker has been over 30 days. This is a leading indicator. Leading indicator. So we have inventory trajectory skyrocketing, days on market over 30 days. And look at this one, price cuts. I mean, the price cuts right now are historical. Never in the history of the United States of America have we had these types of price cuts. It's gone down week over week, but it was up, I think, what did it get, 6.8%? It's historical. It's more than 2022. We're at 6.5 right now. I just showed you my own MLS. The price cuts, that's a leading indicator. It is. It's a leading indicator. It is what it is. All right, guys, let's go into our second video right now. Let me just go back over here real quick. So we're going to go into our second video. Let me just cue that up. The second video is, okay, here's the thing on the second video. So we're going to go in after the real estate. We're going to talk about liquidity and recession. Do you guys think that, well, obviously the markets are being propped up. Whether it's government, it's being propped up. We know that. But let me ask you guys this. How much of the consumer spending that we've seen in the data, how much of that do you guys think is entirely a result of the stock market reaching like crazy highs? Do you guys think that the stock, like Nvidia, Tesla, do you guys think that the stock market is fueling consumer spending right now? Do you guys, let me know what you think. Do you think the stock market is fueling consumer spending? Because remember, the stock market's tied to what? 401ks, retirement plans, pension plans, right? Do you think it's the stock market? Do you guys, what do you guys think? Does median days on market only count sold homes? Bring back 20% down. Okay, tighten it up. Okay, so we got a yes here. Glad to see you. Thank you, Lifted. Appreciate you guys. Appreciate you. Yes. Okay. So I think it is. We're going to listen now to another. We're going to listen to a video. It's going to be a little bit of a bullish video. And I want you guys to understand that when they're talking and advising people, they're talking about investing in the stock market, but they are ruling out a recession. They are ruling out a recession when we have, it seems like every other week, an additional indicator flashing red. So if we have multiple recessionary indicators flashing red, and these people are financial advisors, wouldn't you think that they would take that risk into consideration? Isn't that part of advising, is looking at the entire picture? But they don't do that, guys. They don't do that. And then again, I ask myself, what do we ask ourselves? Why? Why? Anyways, let me know if the video is good, if the audio is good. I hope you guys enjoy.
Does this at all affect the way that you're prepared to trade stocks on Friday, with the fact in mind that we got a jobs report in between here and there?
Yeah, jobs is going to be interesting. I'm wondering if it's going to follow suit like last month, where ADP came in weaker and then U.S. jobs came in stronger. You know, we're expecting 190,000 ads. That might come in a little bit higher up in the 200s is what we think. But overall, right now, the market's had the very Goldilocks, that bad news is good news, like we saw today with the weak ISM. But then good news is also good news to stocks, because then we're seeing continued economic growth and labor health. So right now, I think as long as it's kind of close to status quo, markets are pricing in 2 cuts. Everybody's happy that the economy is not slowing so much that we're concerned about EPS growth and margins. And so you're kind of hitting this eye of the needle right now for stocks, which bad news can be a catalyst and good news can be a catalyst, because it may be coming either with rate cuts or we're seeing a softening economy, but still with a soft landing. And I think that is key. Can we start having rate cuts like we did in kind of 94, 95, and engineer a soft landing, no landing situation without tanking the economy, but bringing inflation down? And that's what stocks, in my opinion, are pricing in right now. So as long as labor doesn't come out of whack too crazy, where we're seeing unemployment rate rise at a rapid rate.
Okay, so she just said, as long as we don't see unemployment, you guys correct me if I'm wrong here, but she just said, as long as we don't see unemployment drastically rise. You guys, unemployment has risen so much recently that it has triggered an additional recessionary indicator, which is the SOM rule. It's like SHA, it's like Sham. Someone just said it. It's on the screen right there. Sham. It's like Tom, but Sham. So the Sham rule was triggered. So she's just said, you heard her, as long as we don't see the trajectory of unemployment getting too crazy, and yet the Sham rule was just triggered. And this is my point I'm trying to make with you guys. This financial advisor, this genius, I don't know how many school loans, but she's probably went to school. She looks like she went to school. I don't know if she went to school. She's not even taking that into consideration. She is literally if I'm listening to her and I know about the SOM rule, and she just said as long as the SOM rule doesn't happen, essentially, and it just happened, then I can't believe anything she's saying. She's on network television. They are speaking to probably hundreds of thousands, if not millions of people. And that's a huge risk. Okay, so when that rule is triggered, the SOM rule is triggered, 100% of the time we've gone into recession. 100% of the time we've gone into recession, and they do not put that into their fundamental mindsets. 100%. And they want to act like as long as it's a soft landing, that's just, it's just not, I don't want to be mean.
I think stocks are going to be able to absorb basically anything the economy throws at them as long.
Okay. She thinks that stocks are going to absorb anything the economy throws at them. How? If there's quantitative tightening, people are losing money. How? Why? Fool! I mean, let's keep going. I'll shut up.
As long as it's on the thesis of a soft or a no landing.
Okay. Mike Santoli, want to get your thoughts on this, bring you into this conversation, too, because some of the labor commentary got my attention. Reduced tightness, further weakening could lead to higher unemployment, and basically that the dual mandate is back in better balance. We've talked about what we've seen in some of the recent jobs data. This does set us up and perhaps put more onus, as we talked about in the past hour, on that jobs report that we're going to get Friday. But as we are just a little over a week and a half out from earnings season getting underway, too, with some expectations very strong for the second half of the year for stocks, how much is that labor piece of the puzzle going to matter here?
I think it matters a fair bit, Morgan, because there has been this run of negative economic surprises in the data releases. The market's been able to absorb it because it was coming from a strong level. It's not outright weakness in the economy. It's just deceleration. I do think that until certainly this meeting and maybe the latest little phase of Fed commentary, there has been a background concern that the Fed was very patient and perhaps saw very little risk to waiting and wanting that clinching inflation data to come through before they can make a gesture to say it's time to start easing. What the stock market really wants is for any move toward a cut to be modest, incremental, orderly, deliberate, slow. Slow easing cycles are better for stocks than not. They don't want deep cuts down, back toward whatever we think the neutral rate is. They want adjustments. And so therefore, starting earlier or maybe starting a little bit proactively before you get outright weakness might be preferred, so long as, we have the evidence we need on inflation. So I think this mostly fits in, as Powell's comments yesterday also fit into that general comfortable zone of where the Fed, where the market would like to see things.
David,
and on that note, David Zervos, I know you were listening for commentary around the neutral rate. How did this strike you?
I just like the idea that we're talking about it, John. I mean, the neutral rate, if you looked at the last 5 years, hasn't budged in the SCP. It's basically been 2.5% with a range of something like 2.4 to 2.6. And then all of a sudden, the top end of the range started to blow out a year ago and then really expanded over the last 3 months, top end of the range now being 3.5. So I'm going to dig through these minutes. It's hard to read them while I'm on with you guys, but I'm casually looking at it and looking at the headlines. And I think it's a healthy discussion. Steve's right. John Williams is not going to be the guy that comes out and talks about a higher neutral rate. He has been a low neutral rate guy from the beginning. I really wonder who the others are, what their power base is, and kind of where their arguments lie. Is this AI? Is this productivity? Is it something to do with the balance sheet? Is it other forces? That's what I want to dig into and understand where they're thinking going into 2025, because it matters a lot where you see this landing of slow, methodical cuts that Mike Santoli's talking about, and Victoria's talking about, kind of a la 1995. It matters where you think they're going to try to tell us they want to stop. Are we going back to something in the low 2s or something in the mid 3s? That's a big difference for valuation.
Yeah. And too bad we can't trust what they're telling us. All right, let's go into liquidity and recessionary stuff right now, y'all. And we're going to take a look at some pretty crazy stuff. Let's start with the yield curve inversion, one of the most trusted recessionary indicators. It's one set of data. It's very easy to take a look at. And this is another set of data with the way things are set up that is basically screaming recession. And so I keep asking, and it's so frustrating, why aren't they putting that into their forecasts? Why, man? I will trust you more. I will trust you more with my money if you can talk about the challenges, explain to me why you think investing my money is still safe, and explain to me what are the risks, like what happens in the recession, right? Like that's what I want to know as a consumer. There's people that are way smarter than me, but their smarts are being purchased and manipulated by their employer. They have this intelligence, but it's being bought and manipulated, and it sucks. And I don't know where to, does anyone know where to go? But anyways, guys, let's look at some of these recessionary indicators, starting with this right here, okay? We got a lot going on with the yield curve inversion. There has been a steepening. And what that steepening means is now it's getting really close to being, here, let me put the 5 here so you guys can see, very close to being back over that black line. Now, I want you guys to remember, when we look at the history, okay, if I max this out, okay, anytime there's that inversion and it goes back, reverts or uninversion, it's generally about, okay, listen to me, this is crazy. It's generally about 6 months before recession is confirmed. I'm sorry, not confirmed, but started. Could be a year before they confirm it. And then they can change all the data, and we can have been in recession since October of 2023, like Danielle, Melody think. So the problem, you guys, is they do change the data. And that's just, I don't know, that's un-American. Anyways, guys, so we have made some progress, okay? So this is a steepening. Now that we're going closer to the reversion, that's called the steepening. This is a bull steepening. A bull steepening is when the lower end of that yield goes down, okay? A bear steepening is when the higher end of the yield closes the gap, okay, the gap between the 2 and the 10. So what's interesting, guys, is we're only 26 basis point inverted right now. Now, if you guys want to know the last time we've been that inverted, it was actually January of this year. So we have a similar inversion since January of this year. But remember what happened. A lot of people are like, oh, we're not in recession. See this here? Or we're heading into recession, and then boom, we just stayed stuck. But look at the trajectory again. Recession's close. It's not far away. We see it in the data all over the place. But what I'm wondering is, and maybe you guys can comment and help me out here. How long do you guys think that we will have to have the reversion before we enter recession? Because remember, it's like we have to be unreverted. The stuff hits the fan. We go into recession, except when? Except during, as you see here, what I'm circling, the 70s and 80s, which just so happened to be an inflation battle. The reason I'm pointing that out is it's actually possible, even though it's not traditional, that we stay inverted even though we're already in recession. And again, I want to bring your attention to the 70s and 80s, and that's exactly what happened. You guys can see it stayed inverted in recession in both in the 70s and the 80s. So it's possible that happens, but generally we go uninverted a few months and then recession. Just want you guys to know that. But you guys, it is rapid. I mean, it's not rapidly. It's kind of, let me go into the 1 year to show you guys. It's kind of tapered off the last day, but the trajectory since June has been going up as far as the reversion or steepening. All right. Huge indicator, but also this is the indicator that I was talking about. The trajectory of unemployment is very, very telling, and that's what I'm trying to explain to people. First of all, the way that they're calculating the unemployment, it has changed. A lot of people are like, you can't, it's like way worse than it is. They don't calculate it correctly. I would agree with that. You can also track the U6, which is the underemployed, but we're going to look at the U3. This is the U3. This is just unemployment right here. We're at 4.1%, but the trajectory, I want you guys to do me and yourself a favor. When you have time, type in Google Fred unemployment rate. And I want you guys to go to this chart and max it out like this. And I want you guys to look, okay, carefully and look at every time unemployment has gone up, it has led us into recession because our economy doesn't work that way. Our economy is supposed to grow and thrive and add jobs. And so when unemployment goes up, it's just like you can't hide the data anymore. It's like we feel it. It's suffering. You're hurting. The market has now crippled, and it's now showing because of the trajectory of unemployment is going up. Go back and look at every time that's gone up and tell me that we don't go into recession. Huge indicator. Huge. Now, look at this. This is what frustrates me right here. Anytime people say the economy is resilient, nah, it's not. The money printing is resilient. The spending more than they have is resilient. This updated. This is actually good news. So it only has gone up to 1.26 trillion. So far for this year to date, we have 1.26 trillion in deficit spending. And again, it's just like when the economy is doing well, we make money. We don't lose 1.26 trillion year to date. And this is just year to date. The year's not even over. We don't lose this type of money in a healthy economy. So the economy is not resilient. In fact, the last time we've had a resilient economy, you could say is 2001. 2001 is the last time that we didn't have deficits. Is that crazy, guys? But the deficit spending right now is completely out of control. It's completely out of control. I hate it. Stop saying, you can say whatever you want. It sounds ridiculous to me because you can't say that when we have this here. This is not anyone guessing. Everyone knows that studies this. This is very bad. This is very unhealthy. This is, again, showing us we are not making enough money compared to what we're spending. And that's not all. Okay, let's look at the liquidity here. This is insane. This is the overnight reverse repo market. This is one of the other reasons other than this. Okay, so this is one reason why things are staying propped up. It's deficit spending. They are flooding the economy with inflation. Plus also there's already money from inflation in the economy from lockdowns. They haven't even got rid of all of that yet. You can see that here in the reverse repo market. We have a double round of inflation. Double round of inflation. We have another round of inflation this year. We know that. The reverse repo market has been stuck since February or the beginning of March. This is just so crazy because look at this has gone down so much. And then again, as of March, it's just stayed flat. That's not good. That's not good at all. Actually, that to me, this tells us rates aren't high enough. And it also tells me that the rich just get richer. It's just like the upper 5-10% of people, they're still doing wonderfully. It's just like everyone else that's watching, most everyone else that's watching, us normal citizen consumers, we're feeling it. We're paying for it. We hurt. It's not fair. We didn't ask for this. We didn't want to get locked down. Take the value of our homes away and give us back affordability. Because if the values of our homes goes down, so does our property taxes and homeowners insurance. So it's not just great, we have equity. But regardless, the reverse repo market has $409 billion still. But here's the thing, you guys. Let's look and talk about how resilient the consumer is. And we're going to look at 10-year charts. So we're going to look at 10-year charts and we're going to say, is the consumer as strong as they were versus 10 years ago? Okay? Can we do that? Because again, we hear consumer strong. Well, look, here's the 10-year graph right here of delinquency on credit cards. Okay. So 10 years ago, Q1 of 2012, the delinquency rate on credit cards was 2.32. And the trajectory was doing what? It was going down. Wow. That's crazy. So it was lower and it was going down. And now look at guys, it is blowing the heck up. So the trajectory of the delinquency rate is skyrocketing. It's at 3.16%. If you look at delinquency rate on credit cards, you can easily tell the consumer is in way worse shape than they were 10 years ago. A resilient consumer doesn't get into more debt and more late payments. A resilient consumer saves their money. But when we look at the personal savings rate and we look again, 10 years, let's go. Is this 10 years? Yeah. Okay, look at right before lockdowns, the savings rate 7.2 to 6.4. See that? And in January of 2019, it was 8.2. 10 years ago, 5.6. 10 years ago, 5.6, and it was pretty much staying flat for the most part. And right now, you guys, we're at 3.9. So from a savings aspect, you can't say the consumer's resilient. 3.9% savings rate is BS. You can't, and the excess savings is gone. You can't say the consumer is stronger. You can't say that. Okay. Here's another thing. This is crazy. This is consumer debt. This is consumer credit card debt. All right. This is the 10-year history. 10 years ago, consumer credit card debt, $611 billion. All right. In 10 years, we didn't double, but we came close to doubling credit card debt. We went from $611 billion to over $1 trillion. Okay. So let me ask you, when they say strong consumer, when they say resilient consumer, do they mean consumers that can still get themselves into debt? Is that their definition of a resilient consumer? Someone that can continue to spend on their credit card right before bankruptcy? I think that's what they're assuming a resilient consumer is. To me, a resilient consumer, bottom line, is someone that can save money. If you can save money and not get into more debt, that's my definition of a resilient consumer. But the information I just showed you is contrary to all of those things. So I think that they're saying a resilient consumer is a consumer that still has money left to charge on their credit cards, which is not, that's not a resilient consumer. It's debt. All right. And let's look at this other thing here. Okay. 10 years. Okay. Yeah. Okay. Income. This is real median household income. Okay. So when we look at the 10-year, people are making more money adjusted for inflation. But I will point out, okay, we peaked in 2019. And so when you see that go down for 1, 2, 3 years, that is concerning. Because if the consumer was resilient, this would be going up. Because we need more money right now, adjusted for inflation, right? We need more money, even numeric. We need more money because it's more expensive to live. And so the fact that we are not making more money as compared to the cost to live, how let's just talk about simple math. How can we possibly be resilient? How can we possibly be more resilient if we have more debt, we're not paying as much, we're not saving as much, and we're making less money? How is that? When people say, what are they talking about, right? I ask myself this, why? You say resilient consumer. Why? Because they have more credit card debt they can charge? That's why, right? It's not, you guys aren't talking about savings rate. The bulls aren't talking about people's, living paycheck to paycheck. If you can't save your money, guys, you're living paycheck to paycheck. I hate to break it to you. You got to try hard. And I'm talking like even a monthly battle, quarterly battle, yearly battle. You have to try to put yourself in a situation to where you can save money. That is like one of the most important things you can do right now is you got to save money. Because what does it take to save money? How do I save money? Spending habits. Big part of that. How I might make more money, spend less, right? There's ways you can do that. All right. So that's that. Let's go into this next thing, guys. This is very important. This is going to be about the buyer's rep. I want you guys to pay attention to this, and I want to know how you feel about it. There's going to be some pretty significant changes when it comes to home buyers paying their realtors. And I think this is bad. I think the law changes are bad. I think that it has the potential to have some good things come of it, but I think it's bad because essentially the law is now requiring you as a buyer to sign a buyer's rep. I never sign buyer's reps. When I represent people, the only time I will sign a buyer's rep is when we are ready to put in an offer and I specify the buyer's reps for that property. So that means if I have a client and we can't get that property, they can walk away. The thing is like they won't walk away if you prove your value. If you prove your value, they're not going to walk away. So why sign the agreement? And the other thing, sometimes they don't have to let you out. Is Troy online? Where's Trey? Troy, what am I talking about? Troy. Have you guys seen that movie, Troy? Great movie, great movie. Trey, where you at, Trey? Let them know what happened, Trey. You guys, Trey. If you guys are in our Discord, you know who Trey is. Trey okay. I was so upset about that. I was about to make a video on this company. The company that Trey had a buyer's rep with initially refused to let him out. People don't talk about that. People just say, I could just get out. Well, in order for Trey to got out of that buyer's rep agreement, he had to argue and fight with the broker. Because the agent that, by the way, is representing the broker, the agent said, no, I'm not going to let you out. You got to wait till December or you're going to pay me a commission. They said that to Trey. And Trey was scared. He was freaked out. He's like, Travis, oh my God, I'm so depressed. I can't believe they did this to me. And I was like, Trey, when I was warning you this whole time, what did you think I was talking about? And he's like, oh, whatever. But my point is, you got to take this process seriously. And you got to understand that people play dirty. And the only way that Trey was able to get out is he had a fight. Now, he had the backing of our community. And I said, Trey, if they mess with you, we're going to come at them. As a community, we're going to report them. We're going to say, don't do business with this broker because they tried to trap their clients into using them, even though they don't want to use you. To force a client, to use you that doesn't want to use you is slimy. And I get it. Agents are like, well, what about the driving? And what about this? And, well, then don't drive and get out of it. Do something else. If you're going to whine and cry about potentially making $15,000 to $20,000 because you have to drive on the weekend, kick rocks. Goodbye. We don't need you. Because houses sell themselves. Realtors, know your role. What realtor are you? Are you a cheerleader? Or are you a realtor that's using data to help the community? Are you using data realtors? Or are you a cheerleader? We got room for one, but not the other. We don't have room for cheerleaders. Okay, we saw what cheerleading does. Look at the buyer's remorse. Look at the fear of missing out. Look at all these things. Look at the prices. Look at the toxicity. Look at the lawsuits. We've already seen cheerleading does not work for us. We need more realtors opening MLS, doing these data analysis, looking at subdivisions, and trying to explain to consumers and citizens, how does value work? How does value work? All of that to say, I hope you guys like this next video. It's on the buyer's rep.
We move on next here tonight to our cover story, and it involves some big changes.
All right, let me throw this up for you guys. Let me know if you like this and that the audio is okay. Here is our next video.
That could impact how you pay for your home. We hear your frustration about the rising cost of living here in Tampa Bay. So tonight, ABC Action News reporter Michael Paluska is taking an in-depth look at a lawsuit that buyers filed and what you need to know if you're planning to buy a home in the near future.
I've been talking with realtors about this issue here in Florida and really across the country, and it's a mixed bag. Some are freaking out, I'm told. Others think it's not a big deal, and some think it'll be really good for buyers that are thinking about jumping into this market. But we wanted to sit down with the experts and give you guys some tips and advice about how to navigate the changes. How the United States does real estate is getting a makeover. There is a lot to cover. This report will hit the highlights.
I think that there's a lot of misinformation on it.
Kelly Ackley is a global sales advisor with Premier Sotheby's. She tells me starting in August, commissions will be removed from the MLS listing, and everyone will have to sign a buyer brokerage agreement.
And on that is going to be an agreed upon commission for what you are going to compensate your buyer's agent for. But now that sellers are not required to pay me, buyer, you are going to have to agree to pay me.
Hold on. You guys hear this BS? How is this a victory? How is this a victory for consumers? So they're going to hide the commission somewhere else, you guys. They're going to force you to sign a buyer's rep, and they're going to hide that commission somewhere else, and you're not going to know about it. How is this helping consumers? If we don't put a cap on commission, they're just going to find a loophole. I'm going to tell you guys, they're just going to find a loophole. You must put a cap on commission. They did that with loan officers through the Dodd-Frank Wall Street Reform Act, and it crippled us at first, but thank God that they did it. It was painful, but thank God that they did it. If they don't do that here, guys, this is, I don't see how this is, especially the buyers. We need more help as buyers. This is going to hurt buyers. Let's keep going.
If I find you a home where the seller is no longer willing to pay the buyer agent commission, Mr. Buyer, you will pay me the 3%.
Industry-wide concerns are rising about first-time home buyers, low-income families, and veterans. Can it knock someone out of a price range for a home they're looking to buy?
Absolutely. They are on a tight budget, right? So we get them pre-approved and we try to stay within that budget. They aren't going to have the extra 2.5%, 3% to pay an agent. So that's where we're going to get creative.
That number doesn't even include rising homeowners insurance, flood premiums, and taxes, also barriers to entry.
Would you come here and interview me if this was a freebie? Maybe not. And so...
Okay. I want you guys to listen to this dude. Okay. This dude, I know I'm biased. Okay. I've worked with over 1,000 realtors. I know I'm biased. I know it sounds like I'm bashing realtors. Maybe it's tough love. Okay. It's a tough love thing, but this guy's a total dirtbag. All right. I could see right through this guy. Listen to how he's explaining this. This guy's talking like he's a doctor. He's a lawyer. This guy's a cheap Domino pizza delivery sales rep that's suffering from his business that is helping with the fear of missing out. Listen to him explain this, you guys. Listen.
Real estate agents shouldn't be expected to work for free either.
I would, just to get the free advice.
Everybody loves free advice, especially family and friends.
And we'll give it to our viewers.
Yes, sir.
Jay Quigley is a broker associate with Florida Executive Realty. He tells me buyers have to do their homework. Interview multiple realtors, read reviews, do a trial run with that realtor. When you sign the contract, and if you think it isn't working out, you can break up with them.
If a buyer doesn't want to commit to me, frankly, why would I want to commit my evenings, my weekends, my holidays?
You guys see? Commit to him? What about the commitment to buy the house? I'm just saying, what a selfish SOB. This guy's a selfish SOB because he's only talking about himself. Why would I want to work with you if you don't commit, which means if you don't sign this form, if you don't let me make my 3% commission, I don't care about you. Talk about putting the cart before the horse, or rather his commission before his client.
To a buyer that doesn't want to commit to me.
Should I negotiate commission with my realtor?
Yes, you can, but it's kind of like if you want that very nice watch, but you know it costs $5,000.
What?
Do you think you're going to go into the jeweler and say, I really want that watch, but I'm only going to pay you $3,500?
With all of that being said,
that guy
commissions
Rolex?
are negotiable.
You guys, this is simple data. And here, I just, couple things. I want you guys, we're going to go into the Q&A section real quick. Let's go into the Q&A section. That guy makes me so mad. I want you guys to throw up some questions if you can. I wanted to throw this one up as well because this is good. Boom. All right, so I want to do some Q&As. Give me some Q&As. If we have enough time, I'll listen to another video, but don't give me the A's, just give me the Q's. Listen to Nightcray, okay? If a realtor finds me a place that meets my needs, negotiates concessions, gives me a real market analysis using proper comparables, I don't mind paying. Nightcray, you should mind paying. When it's generally, and this is why I say this, generally when someone purchases a house, they extend themselves, hopefully not overextend. You don't want to pay them, brother. Just like I don't pay my closing costs, the seller pays my closing costs. The seller needs to pay for the realtor in your negotiations. But here's what I'm going to do, okay? This is why I'm putting up this comment. My whole plan, again, I have the template for 8 classes. My plan when I have this school, and I may do less videos on YouTube and put more time and attention to school because we're getting closer to finding great deals out there. I want to put you, Nightcry, in a situation to where you don't even need a buyer's rep. I want to have a school that is so powerful, that is so valuable that you don't even need a buyer's rep. Now it's going to be hard. I'm going to have to do every single step of the transaction, and I'm going to have to teach you guys what to look out for, red flags, but I don't want you paying. That's why I put this up. My plan is to put so much value in your hands, Nightcry, that you don't pay $18,000 for someone that holds the door open for you and does simple math on a market analysis. It takes me 10 minutes, Nightcry. I do it all the time on the light. It takes me 10 minutes to do a market analysis, and that's worth $18,000 of yours? Nightcry, give me $15,000 and I'll teach you how to do it yourself. See, that doesn't sound good, right? Don't give me 15. I'm just kidding. But my point is, I'm going to teach you, brother. I'm going to teach you. Don't be paying them. Don't be paying them. All right, here's House Hacker. Let's see what I put this one up here. I live like I'm broke. My only debt is 2 houses. Okay, so here's what House Hacker, see, this is beautiful. You guys, I want you guys to understand how valuable community is and having a conversation with each other and trying to have a relationship. I've learned a lot from House Hacker. He's my boots on the ground dude in San Diego. I kind of lean on him like, hey, what's going on in San Diego? But you guys, here's the thing. House Hacker and I started out butting heads. And some people actually got mad at me. They're like, Jerry, why are you beating up House Hackers? Because I care about him. Because I respect him, I'm beating him up. But here's the thing, guys. Like me and House Hacker, we used to beat each other up. House Hacker's like, oh, you're just a doomer, Travis. The prices aren't going down. I'm just like, oh, you're just I don't know. What did I call you? I don't even know. You're just buy, fear of missing out. But the reality is, when both House Hacker and I calmed down and started talking and asking the question, why? We started learning from each other. So House Hacker, thank you, bro. Like, dude, you have the ability, House Hacker, to give people hope in a really bad market and to explain to them how you did it. And look at how he did it. He's living like he's broke. Remember, I told you guys there's 2 things. It's the economy and all that crap that's going on. But the second piece of the pie is you. And I'm talking to you. You are the solution. You are a big part of the solution. Look at what House Hacker's doing. He's living like he's broke. That's beautiful. I love it. I just want to pull that one up there. All right, this is interesting. Bank bail-ins are going to suck. Now, what they're referring to, guys, is what should have happened to Oprah and Gavin Newsom when they bailed out the banks. So they bailed out the banks illegally. By law, they should have done a bank bail-in where they take the depositors' money. That's over $250,000. But they bailed out the rich and elite. Oprah, Roku, they bailed out the banks. Literally, that just made it worse for us as a consumers. They hurt us. No one benefited from that needed the benefit. Do you guys think that Oprah needed that? Just saying. All right, let me see if there's any questions here. All right, let's see. I agree with this one. Everyone should have access to MLS. I could teach you guys so much. Okay, let's see what reverse trolling Johnny's doing today. Let me just see if there's any other questions real quick. You guys throw up some questions. I kind of got back on the questions a little bit. If there's any questions, you guys throw them up, like loan questions. You guys got FICO score questions, CMA questions. All right, so question, shouldn't the government step in to waive down payments so people could afford to buy a house? Here's the thing, Johnny. I'm going to tell you guys, the house market's so out of whack right now. Even if they waived the down payment requirement, which is only 3% for Home Possible and Home Ready Conventional, which is a first-time home buyer program, but generally it's 5%. FHA is 3.5%. You guys, a 5%, 3.5% down payment, it barely changes your payment. So it's not going to make it more affordable. It's just going to require, more money out of your pocket. So I don't think the government should do that, to be honest with you. But I will say, Johnny, even if they do that, I'm telling you, it's not going to make houses more affordable. It's just going to put people in a worse, more risky situation. How could it's going to make it more expensive, because the more down you put, the slightly lower your payment is, right? All right, let me see. What's the about to get my real estate license? Okay. Let me see what Deuster has to say here. Ever thought about doing a video on buying land? The process differences of buying land could be another great option for someone. What I'll do, Deuster, is like, because those videos, I don't know why I get penalized almost for doing those. These are some of the classes I'll be teaching once I have my school up and running, is like land, how to walk a property, wedge, cash flow. So I will be actually talking about this, but this will be more specific to a teachable community. Here's a thing from Andy. C-Main appraisals are no longer reliable due to far too many unreported concessions by builders. Exactly. That's you know what? Let me show you. Okay, take a look. I just so happen to have this appraisal up here. So this is a recent appraisal. And to that person's point, the comment on the screen, let me zoom in and I'm going to show you. The very first comp, you see that number 1 right there? That very first comp. Where's my pen? Dang it. Hold on one second, you guys. Let me freeze this real quick so you can't see what I'm doing, because I know where my pen is. It's right here. All right. Let me show you. This very first comparable. By the way, I had a viewer send me their appraisal. I found 2 issues on comp 1 and 2 immediately out the gate. They're not doing this right. But look at on this very first appraisal, this very first comp, there's seller concessions right here for $10,000. You see that? That's $10,000 seller concessions. Concessions is here. See, it defines that, concessions. But look at you guys. No reduction in value was given. This happens all the time. They need to be summoned to Congress. And honestly, I think this is ground for lawsuit. I don't know for sure, but I think it is, because this is what should have happened in this appraisal. Negative 10,000. That's how they're supposed to do that. As long as this subject property here didn't get $10,000 in concessions. And I know they didn't get $10,000 in concessions because I represented them in this transaction, and they did not get $10,000 in reductions. So the appraiser should have reduced the value in comp 1 by that $10,000 according to the law and regulations and guidelines of Freddie Mac, the CFPB, Freddie Mac, Dodd-Frank Wall Street Reform Act. But they're just getting away with it. You guys, they're just getting away with it. This is insane. It's not going to end well. Okay, let's see what else we got here. What are the effects of the adjustable rate mortgages? It depends, because, well, first of all, the rate buy downs, they're getting squeezed hard. So the loans that weren't traditional adjustable rate mortgages, they were just temporary buy downs, they're all adjusting. They're going to adjust like crazy into 2025. And that's going to hurt people, because remember, most of that is on new homes. And remember, with new homes, they get surprise property tax bills on top of a higher mortgage payment. So you got mortgage payments skyrocketing, you got property tax skyrocketing, and the older your home gets, your homeowner's insurance goes up. So the effect of those arms is going to put some people that were not prepared, that were expecting to refinance because they were promised just refinance later, it's going to put them in a hardship. How many people bought a house expecting to refinance in a few months? And by the way, that's dangerous to do. Okay, let's see here. Okay, here's a good one. Is it better to put 10% down and 10% against amortization, or just 20% down? I would think former would save you a lot more money. So both are good. I'm just going to say it doesn't matter, Nikki, as long as you're putting, okay. When I do a dollar for dollar comparison, they're about the same, but if you do the 10%, if you do the 20% down payment, you also have to put additional money towards principal. as well. In other words, I want you guys to look at paying your amortization schedule down like this. It's almost as if you put more money down. So say I close on a house and I put $10,000 into my amortization schedule. It's almost as if I put that $10,000 into my down payment. So Nikki, I will say this. I'm not a guy that thinks that you have to put 20% down to buy a house. I'm not. I don't think so in a normal market. In a normal market, I don't think so. And in this market, being that home values are going to probably go down, I think that we don't want to be going broke on our down payment. I think, Nikki, if you put 20% down, make sure you have a year's worth of savings. If you have a year's worth of savings and you want to put 20% down, that could be good as long as you're avoiding PMI, private mortgage insurance. So that means you can't get an FHA. If you get an FHA at 20% down, you're going to have mortgage insurance for 11 years. So hopefully you're getting conventional. But again, you got to be careful not overextending yourself when you move in. So what's better? It depends on how much money you have after you close, right? So if you have plenty of money after you close, by all means, if you want, put 20% down. If you have a lot of money, if you don't have a lot of money, I don't know that 20% is the best thing. It really depends on your situation. Okay. Okay, so vintage, they have a different algorithm. And it's possible also that it's not higher. It just depends on the algorithm not creating, because not every account is going to report to both. Like you may have a late payment on FICO and not Vantage. So it just depends. And it's also a different algorithm. But it's all the same principles, right? It's like your utilization ratio, don't overcharge your credit cards, don't ever be late, don't have any collections. It's all the same principles. All right, let's see here. Question, why not have separate loan for first-time buyers and premiums on second home? They do. They do, Sheldon. So the separate loan for first-time home buyers for conventional, Sheldon, that's called Home Possible. Write this down, because this is actually good. And you have to be a first-time home buyer, which means you can't have owned a home in 3 years. That's what it means. It's 3% down, first-time home buyer program. And I can't remember. I think it's Home Possible. Could be Home Ready. You have a lower PMI. So you have lower PMI, lower down payment, and it's a conventional mortgage. That's a first-time home buyer. Second homes come with an additional what's called an LLPA, which is a loan level pricing adjustment. So you get a penalty if it's a second home. Does that make sense, Sheldon? Okay. So okay. I think that's Natalie has a question. Husband makes $90,000. How much home can he afford? Great credit, $20K down. Big piece of the pie. How much debt do you have? Right? So this is what I want to say. Go to an affordability calculator. I have it on my normal videos, like my edited videos, not my live. Go to my edited videos, go to the description, and I have an affordability calculator. Put your income in there, but the important thing is put your debt monthly payments, okay? And you can figure that out. Let's see if I have anything else here, you guys, and I'm going to get us out of here. Red ink. I don't know. I do have red ink. I thought appraisals were an art, not a science. No, appraisals are an opinion. And I'm going to tell you, Mr. Cigars. Oh, it's my man, Mr. I'm going to tell you, man, their opinions are crap. Their opinions, some of their opinions are crap, but it is an opinion. Okay, Mav, market is acting on the probable election results. Will that housing market still crash? So will the housing market crash depending on who becomes president? Mav, brother, I know this is hard to, okay. I know this is hard. There's a lot of moving parts. But I mean, dude, you got to look at the right stuff, right? Has income gone up? Is the PE, price to earning ratio, is that still going up? Last I looked, it was 7.7, the highest in history. PE ratio was the 70s and 80s. Income in the gutter. Credit card delinquencies going up. Is the president going to pay my bills? I'll tell you what, Mav, if the president pays my bills and all of our bills, then we won't have a housing market crash for a period of time. Okay, but they got to pay all of our bills, right? Brother, listen. It doesn't matter who's president. Okay, I got to be careful saying this. They're a puppet, man. I don't know how to say it. They're a puppet, bro. They're a puppet. They're a puppet. Okay, so I'm just going to answer your question. In my opinion, Mav, it's 100% going to crash. It's 100%. Why wouldn't it? Why wouldn't it? Mav, ask yourself the question, why would the housing market not crash? Because that's what we hear in mainstream media. But then ask why. Are you asking yourself why, my man? I hope you're asking yourself why, my friend. Okay, thanks for the shout out. Oh yeah, dude, of course. Do you see the video? Let me see. Do you see the video of the guy dehooking a hammerhead in a thunderstorm? Yes, I saw that. He used his finger. I hate it. Anytime I see someone using their hands to dehook, it drives me crazy, even though I just got bit. All right, guys. I think, let me see if there's anything. Okay, so what he's talking about, here, this is House Hacker. He has a VA loan, so he's gonna want a VA over FHA, and VA has a similar. It's called a IRRL, IRRL. There's a streamline, but a streamline is where you can actually refinance kind of for free. The disadvantage is okay. So because the FHA streamline is not as profitable for lenders, they usually pass on that lack of profitability to you by raising your interest rate. So usually, though, not always, but most of the time, if you do a streamline, your interest rate will be higher than market because the lender will pass on some type of LLPA, loan level pricing adjustment, to recoup that loss. But it is good. It is good. Streamline is good. Okay, let's see, guys. I really appreciate you guys. We've been on talking for a long time. You were hustling. Hustling shark meat, side hustle for the. I don't kill the sharks. I don't kill them. People are like, well, why do you do it? I mean, I just like the adventure. I tag, I turn in the data. We track the migration. It's just so fun. Okay, and then here's the thing, House Hacker. You can't so you got to be careful. FHA can always refinance without equity and lower interest rate. That's not true. Okay, and this is what I said. There's nothing that's always. Especially when it comes to loans, you still got to meet basic criteria. Like if you don't have a job no more, you can't get it, right? If she don't have a job no more, she can't get that streamline because you don't got no job, right? So you got to be careful with always. The important thing, the concept that I want you to gain from House Hacker's comment here is you just have to understand how the streamline works, right? That's really what I think he's trying to say is like understand how it works so that you can prepare for it, right? I think that's fair to say, but so understand that concept, like, oh, a streamline and FHA, that sounds good. Kind of how does that work, right? Let's see, you guys. Really appreciate some of these questions here. Oh my gosh. Okay, the biggest purchase making our lives. Jesus loves you. I love it. I love it. Thank you. Repent and accept Jesus. Cool. Appreciate you. I try not to get religious or political. It's a real estate channel, but I mean, I have my religious and political views. Okay, good. Exactly. Okay, I'm going to probably do a video on that one, Jungle Book. By the way, another good guy in our community, Jungle Book, is going to be leading one of our lives, hopefully shortly here. I've been so far behind. Where's my buddy Deuster? Look at, see Deuster, House Hack. Look at it. We're all friends here, you guys. We're all friends. Let's build a bigger community. You guys have a great day. You know, I just want to leave you on. You guys are in control. Your decisions are important. You guys don't have to be a part of this nonsense. You guys can do your own thing. You guys can save your money. In fact, you should, because why not? And, again, remember, in my opinion, what's life about? It's relationships, family, friends. I mean, you guys mean so much to me. House Hacker, Jungle Book, Mike, Deuster, everyone, even the trolls. You guys mean a lot to me. I love the community. I will continue to do the best I can to get you guys breaking information, be completely transparent about my own situation and journey, and then just be honest about my opinions and then continue to ask myself why. I will continue to listen to the bulls. I will continue to listen to people that disagree with me, and I will continue to ask the question, why? And I really appreciate you guys. One more thing, if you guys have recently purchased a new home, please email me a copy of your appraisal. All right? Email me a copy of your appraisal if you purchased a new home within the last 2 years. Please do that. My email is in the description. My email is in the contact on my main page. It's in any of my edited videos. Please email me. I really appreciate you guys. I'm going to get out of here. Lots of love. I'll see you guys on Discord. Sorry I haven't been, talking as much in there. It's just been super hard. But anyways, guys, other than that, if you're out there investing in real estate, you guys already know, I wish you luck, and I hope you